Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, August 6, 2026. What we're going to do in this video is something a little bit different. We're going to look at the same index. We're only going to look at QQQ, and we're really going to just focus on one time frame, the current time frame that the active trade is based off, which is a 60-minute chart. But what I'm going to do is a comparison. I was just, that's what I do. I'm a chart hound. I'm just pouring through charts all day looking for anything that stands out. So what we're going to do here, real quick in a nutshell, this is the daily chart, just why I'm on it. There's that resistance level that we hit. And it's also, remember, a back test of the symmetrical triangle pattern. We had a symmetrical triangle pattern. We broke down, hit T2, perfect. That's T2 on the 60-minute time frame where this current trade is based. We hit T1 right here. T4, my final target, is down here around 636, and so that was a confluence of resistance. Again, it's a back test of the when you extend the triangle pattern here, and we went a little bit over the downtrend line, but we continue to backtest the uptrend line, the lower line, and again, price resistance. But here's what we're going to do. We're going to compare. We're going to do that was then, this is now. And so let me turn off all the lines here. Let me just jump back to a 2-day chart, and let's talk about this. So the last bear market, again, there's, in my opinion, there's two real bear markets in recent history, in decades. And that was the dot-com bubble from March of 2000 when the NASDAQ peaked, and it fell 78% from there into the 2002 lows. And so I call it a real bear market because it ran its course like a normal bear market. It was over a year long in duration. And 78% drop in the NASDAQ. The S&P held up much better because it wasn't so full of tech stocks. And then we had a real bear market that, again, tons of intervention, don't get me wrong, but it was well over a year. It was October 10th of 2007 when the markets peaked, and they troughed. The majority of indexes troughed, bottomed in early March of 2009. So again, you had a little over a year period, and that's historically bear markets will run about a year and a half or so, give or take. And now this one was a bear market by, again, if you want to, it's semantics, really. You want to call it a correction in an ongoing bull market, you can call it that. But however, statistically, it was certainly a bear market by the definition, the general definition of a drop of 20% off the highs. It was a 38% drop in the NASDAQ 100, less in the S&P, which is normal. The only reason in the financial crisis that the S&P fell almost in lockstep, they both fell about 55, 56%, the NASDAQ 100 and the S&P 500, is because the banks blew up back then, had to be rescued. And as I often talk about, the NASDAQ 100 doesn't have any financials in it. It's a very tech-heavy index, and the financials have always been one of the top sectors in the S&P 500. So that's that one reason there. And again, if we had if there in the future is another credit event, then you can expect the S&P to fall nearly as much as the NASDAQ. But as of now, my crosshairs and the official trades lay here. So, all right, so that's it. It was, and by all metrics, let me just tell you, again, a 38% drop, and that's what we were trading. We were in short just like now, right off the highs. Covering off those lows, getting very bullish in the beginning of 2023 on the mag stocks, overweighting Apple and Amazon were my two favorite coming into the year, starting off 2023. It was a 10.7 month drop from high to low in the NASDAQ. So, call it 11 months, rounded off, 38% drop. So again, it's the closest thing that we've had to a bear market. Even more than COVID. COVID, if you blinked, you missed it. Now, it was considered a bear market. It was a 36% drop in the S&P 500, but it was only over 6 weeks because they hit the nuclear button on that one. And so you really didn't even have a wave count. You had one little counter trend bounce. This went down like a normal bear market with two nice fat counter trend rallies, both of which we gamed with near impunity, covering some shorts as an active trader and showing you the bullish falling wedges, the reason for going long on the 60-minute chart, and then getting back short again there. And so here's what we're going to do. As I went through the charts, it's uncanny how similar they are. So let's start out with what you've been seeing every day now for weeks and months. This is the current 60-minute chart of QQQ. And so what I'm going to do is just pull up. Everything on this site is archived. I'm a big believer in transparency. I haven't seen a site out there, a service that has every single post and call they've ever made easily accessible. A lot of stuff, and there's just so many false claims out there of people calling tops and bottoms that never did. Again, I've called plenty of tops that never materialized, plenty of bottoms that never materialized on stocks in the markets, but collectively, never missed a top, never missed a bottom. For those tops that I called that weren't there, or the bottoms I called weren't there, that's what stops are for. All right, so we're going to go over this. So it just kind of imprint this. I wish I could put the two side by side. The problem with, screen recording, I'm capturing a small part of a very large monitor, which is one of multiple monitors. So I have charts everywhere. You can only see this one. And of course, charts, by definition, just the way price works in the XY axis scale, they're always in landscape mode. And so to try to record this video, putting two landscape mode charts side by side, it doesn't work. They'd be shrunk so small, and then we'd have a lot of white space. You'd have, I think you guys know what I'm talking about. You'd have a rectangle. That's not my rectangle tool. You'd have a rectangle down here and one here, and even that wouldn't fit two charts. That's almost two squares, and then you'd have all the white space. So just kind of take a look at this, and here's what we're going to highlight. So the current trade, which is still an active trade, and this is still the current final target. And I like I said, if we get down there, I will talk about the very open to the potential for additional downside targets. Targets I've already laid out on the longer term weekly time frame, but as you know, I've been focusing, on the 60-minute chart. And for good cause. That's where you can kind of see the levels, the developments that have caused the counter trend bounces. We hit T1, top of my first target zone. We bounced. We hit T2 just last week. What do? We bounced. And now we have the next sell signal here. So the first sell signal, this trade was entered. If you're brand new to the site, we had a trend line coming off the March 30th lows. And before that, and I believe I would have highlighted, we had a breakdown. We had a minor trend line coming off those same lows and a breakdown there. You can see we had divergence that had started and was just barely there. It was about equal highs in the indicators. Then the divergence continued to persist. And then I laid out the official trade here with the entry to come on the breakdown there, and then a break of the lows. So again, all these trades you can just revisit. Click on QQQ, go to the active trades section. You'll see all the charts. So I'm not going to walk through this one. We've been covering this one quite a bit. But just look at the visual and look how we were coming off this divergent low right here on QQQ, busted up through a gap, ran. So now let me show you the charts. We're going to look at I have 5 that I pulled from back then. Let me see if I can get these in order. Where's my November 29th? So we're going to go in order here. Here it is. Okay. So now we've just jumped back in time to late 2021. Oh, wait. No, sorry. My bad, guys. I need to show you how it played out first, and then we'll get to the 60-minute charts. And again, I'm going to show you the similarities. It's almost uncanny where we're at right now. So this, with all the lines off, this is it. So what happened back then, and I pointed it out many times at the time and since, the NASDAQ actually peaked. And I talk about this. When the leaders die, the market usually dies. The leader, you take out the general on the field. The troops start scattering. They don't know they're not getting direction. They don't know which way to go. And that's usually it. So what happened back then, And here, we'll zoom in nice and tight, and I'll try to make this a little quick as possible here. So the NASDAQ actually peaked right here on, that was November, let's see, I've got it written down in my notes here, on Monday, November 22nd, 2021, right here, right? And you can see on the crosshairs, the pop-up box on the left will tell you that. Then we put in an almost equal but a lower high. We failed to equal that high, and so that's the official start of the bear market, and that's where I measured that 38% drop. You can see the pop-up box on the left, 37.93, I round off. And you can see it spanned 10.8 months. Okay, so that was it. That was then. And back then as well, just like today, the S&P 500, unlike the NASDAQ, because financials and other things were pulling it up, even though tech was, holding the NASDAQ 100 back, the S&P 500 via SPY right here continued to climb after that same peak. It had a peak on the same day, the very day the NASDAQ topped, November 22nd, and continued to climb for another 1.4 months. It was a total rise, I wrote it down, about 1.4%, a marginal new and still divergent high. Turn on all the lines, you can see it was still a divergent high. And again, that's what started the bear market in the S&P 500, okay? So that was then, and just wanted to point it out, that the S&P, the Dow, all the stuff that was playing a game of catch-up while tech was wobbling went on, punched out. And I say that, because it's all been over the headlines. The media jumps all over the new highs in the market, as they always do. So that was then, this is now. So let me turn on all my lines. Just like then, if you recall, I'm going to show you here. For weeks and even months now, since I said if any new high anytime soon, I was very open to the possibility would be a divergent high in the indexes, and it still will. And if we get it in the QQQ, we don't have it yet, but that's what this check means. I remember I had the yellow projection line. I don't know why they keep disappearing. A lot of my lines disappear on this platform, but there it is. So you have negative divergence on this breakout, this all-time high in the S&P 500. You have it in the Dow. But when we look at QQQ, just like back then, peaked and has failed to make a new high. And again, I'm going to tell you I have, I call them mixed thoughts, but here's the thing. When I walk you through the charts, these similarities are uncanny. And, the whole core, what I believe, and I haven't read this or heard it, it's just my theory how technical analysis evolved way back when, before I was in diapers or even around. Folks started realizing there were certain patterns that would repeat in the financial markets. And that I assume is the early evolution of technical analysis, studying similarities, whether it's volume, price, candlesticks, trend lines, bullish and bearish chart patterns started to emerge and evolve. And so, that's been built upon, and that was how technical analysis developed. Basically, it's looking at what happened in the past, similarities, recognizing similar patterns in market action to then identify when those similar patterns emerge, i.e. bullish and bearish developments, chart patterns, divergences, overbought, oversold conditions, candlestick buy and sell signals, and bullish and bearish reversals and all that other stuff, everything that technical analysis encompasses, to take that and then predict what's going to happen. That's why I named the site right side of the chart. I put a buffer here, but when a chart, by definition, you're going to have the, how do I do this here? Here it is. Here's today. There's the price scale. There's where we're at. And so I moved this over a little bit because this site, and again, it's what trading and even investing is all about. You're trying to predict where any security or the market, is it going to go up? Is it going to go down? Is it going to be dead money? In which case, move on, find some better fish to fry elsewhere. So let's dive into the charts. Let's go back to my 60-minute. And what I'll do in this video, I'll put these screenshots up. So this is the current setup right now, and most recently. So we had the components here were the similarities I'm about to highlight. is we had a minor trend line. It put in a divergent high, triggered a little sell signal, but the divergence kept building. And then we had a what I consider a much more higher probability. There was a very well-defined trend line. And that's what made that this most recent official trade with 1, 2, 3, 4 price targets given. 2 of those targets already being hit. Still maintaining this one despite the strength. And again, I'm doing this because I read the same headlines you guys do. The media is drooling all over themselves, citing one of the strongest 3-4 day rallies in years, all the silly statistics they always throw out. And as I've talked about often, the biggest gains, and I don't know the exact percentage, but you can go look it up yourself. The biggest single day gains, the biggest multi-day gains, the vast majority of those in the record books come during bear markets and or corrections. It's just the way it works, right? And when I'm talking about, if you want to say, in 2009 when the bear market was over, yeah, you have an explosive move off the bottom. Same with COVID, right? But that was the result of, it was the tail end of the bear market. So technically, yes, once the market's bottom in March of 2020 at the COVID lows, if you look back in hindsight, you can say that was the beginning of the bull market, but it was really the final short covering rally. And that's what makes those moves so explosive in bear markets, whether it's the counter trend rallies on the way down to the bottom or that move off the bottom. So I'm kind of including that one there, if you will. But you don't get at the top of a bull market, rarely are you going to get those record surges. It's atypical. Okay, let's just leave it at that. All right, now let's get to the similarities. So we're going to go to, and we're going to just walk them in order. All my charts, as always, are time stamped, and so you can also see they're time stamped down on the bottom. So this is November 29th. Remember, let me repeat, the NASDAQ 100 peaked on November 22nd, 2021. That was the official start of that 38% bear market off that high. And so just a few days later, now we already, I could have, but I didn't go back any further. I think you get the point. I was already highlighting, just like now, we had this almost identical, and I didn't move this line. One thing I would do is do this and tell you we had, just like now, almost equal highs right there, almost burned through, and slightly technically burned through the divergence a little. But again, when I look at this, for all intents and purposes, that's equal highs. Technically it's a hair higher on the PPO, but we made an equal or slightly lower high on the RSI. So that was divergent high 1, sell signal 1, then set up a bigger, more powerful trend line. And again, these are unedited. These are how they were saved. So that was our sell signal 2. And then you could see I had us going down, and I was also trading off the 60-minute chart. So as you guys know, it's one of my favorite swing trading time frames, but you know how that saying goes that even the longest journey begins with the first step. Every bottom I've ever called on a stock, a commodity, or anything else, or the indexes on a bull market, in probably every instance, we were in first based on bullish developments on the 60-minute chart or the intraday charts, usually the 60. And I'm talking bullish falling wedges and or other type of things, pullbacks to key moving averages, my final price targets being hit, candlestick reversal patterns, etc. So back here, that's where we had 2 sell signals. And I can't remember, we'll go check it. It doesn't matter whether that was the official entry or that one. They're around the same price. And you can see I had 4 targets going down. And again, I expanded as time went on, because I'm going to show you one more thing, a similarity between now and then as well, which I should have covered before. Turn off all the lines just to make it clear. This was, nope, I've got a 100-day. Yep, that's the same thing. So I flipped. What I had to do here is toggle to a 2-day period chart. If you notice up top, my daily chart right here, I have the 200-day moving averages. You guys know I'm big fan of the 200 days, helping to define trends, bullish or bearish trends. And so if you toggle to a 2-day period chart, what you're doing is, instead of every candlestick being 1 day of trading, it's now 2 days. So you have to change your moving average to a 100 period to give you a 200-day moving average, right? Because every candlestick's 2 days. So it's the same thing. So back then, you can see we had our early sell signals. So we were short based on the 60-minute charts, but then this is where things started to change. We were this far above the 200-day moving average right there. Not much different than now. This time we recently hit and bounced. But if we go down and take it out, then again, bigger things may be about to unfold. So we'll cross that bridge when we come to it. Again, to reiterate, bears repeating, my fourth and final target currently lines up approximately with the 200 days. So when we get there, maybe they buy it. Maybe we slice right through it. I'll let you know my thoughts then. But let's get back to the comparison. So one more look at where we're at now. Break, minor trend line break, divergent high. The divergence got bigger. A more significant trend line broke. We've been zigzagging down. And just the other day, so recently when we hit T2, I told you a bounce was likely. Reaction was likely, meaning in favor to bounce. We got a bounce. And then the other day, before we broke it, I said this would be your next sell signal. See this uptrend line here? So this comes after zigging down for a few weeks. Nice, clean, well-defined uptrend line, truncated so far. Now, it's not to say we can't do this. The only thing giving me pause about this whole video, I'm going to show you these similarities, is that it's almost too similar. And I get a little bit uneasy feeling. I often say history often repeats. History doesn't always repeat, but it often rhymes. So this could play out the same way. But sometimes when things just start mirroring it, I don't know if it's a jinx thing or just keep that in mind, that anything's open. But again, I haven't waffled on what I said, and I maintain that should the NASDAQ punch up, make any new high anytime soon, it will. If it happens soon, it's guaranteed to be a divergent high on the daily chart and the weekly charts, and therefore I put good odds that it will fail, and I still maintain T4. Whether or not we got a little upside first and we go a little bit underwater off the initial entry or not. So go back to where we were. This was, where is it? Right here. The first chart I gave you, just showing you, that we were short, looking for downside. Obviously, arrow breaks always denote where you're likely to get a reaction upon the initial tag. And again, I'm zoomed in a little bit so this trend line doesn't look as steep, but there's that first minor trend line. There's that same divergence that we had just recently on the 60-minute chart of QQQ. Oh, we were coming off a divergent low. I had a nice gap right here. Oh, there's a gap. Gap got taken out. So it was check, check, check. That was the catalyst for the rally. And let's go to the next one. So that was November 29th. My next chart I posted was December 16th. Fortunately, these aren't in order. Let me hover over them. Here we go. December 16th. You're right here. Okay, so that was it. So I also pointed out that breakout, remember, which marked the highs, November 22nd, proved to be, as I predicted it would be, a failed breakout. Why? Why would make me think a breakout's not going to stick? Well, as I often say, breakouts that occur with negative divergences and overbought conditions. And there's that same almost identical flat line divergence up to the first point. Like I said, this is the chart how it was back then. That line should have been moved up there. That was a divergent high. So initial breakdown, but then the primary trend line broke, almost identical to this current trend line, especially, like I said, here, we can do it this way. You can move and we can do it this way. Take what's already happened. There, that's what it looks like. This is the current chart. And so this mirrors that chart right here. There's our breakdown. We went on that case. We went through T1 and we hit T2 just like now. And then we had a heck of a bounce. And you can see this pre-market bounce back to the 401 resistance level offers another objective shorting op for active traders with a relatively tight stop, or a wider stop for trend traders to allow for a marginal new high before the next leg down. exactly what I've been saying lately. If you took the initial short, again, this is 2 years ago. This is 2020, late 2021, more than 2 years ago, a couple of years ago. That was comparable to this current sell signal. And I said, if you took that and you're going for the prize, then you can use easily a 3-to-1 risk reward ratio and allow. There's that marginal new high scenario. And it never played out. It was an alternative scenario. When I give you two arrows, and I've made clear on this, they're all going to lead to the same area. It's just a matter of we're going to have a little move against the position first, and that's why I do a lighter color. The solid arrows or the brighter colors are always my preferred scenario. And just like now, I've been highlighting bounce, so if back then you covered that quick drop to T2, these were your objective shorting entries. And I'm going to go to the next one here. So that was December 16th. Next chart I posted was January 10th. Where are you? January 10th, right here. Okay. Again, we're talking late 2021, just before the start of the year. This was the beginning of January 2022. There was our sell signal, almost identical in scope. Everything leading up, even that big gap, breakaway gap like we had right now, or a few months ago that led to the new highs in the NASDAQ. We had the sell signal. We went in a choppy trading range. I remember back then the comments, the same folks that are always saying the market's just going to keep going up. We're saying it's going to go up, and this is a good buying opportunity and all that. The S&P at this point went on and put in that new high I showed you, but the NASDAQ, and this again was a red flag in my opinion, because the NASDAQ 100 to me is the most important index because it's a very concentrated view of these stocks that matter. Procter & Gamble can go to the moon, Mars, Jupiter, and back in price, but it's not going to move the needle compared to what NVIDIA, Meta, Amazon, Apple, those multi-trillion-dollar companies. It's due to the mathematical weighting and really the importance that they have on the overall economy, but of course the stock market as well. So there it is, guys. And here's what I want to point out. So after a little bit of sideways action, after bouncing off the second target, we had a nice clean uptrend line right there. You can see that, and we broke it. And we broke it. It was a clean sell signal. We wobbled down, and you can see, what did we do? Wobbled for a little bit, and boom, we started going down pretty hard. And we hit my next third target, right? And this was posted on, again, January 10th. All right, then, and I'm not going to go through any. I have one more from back then, January 20th. Again, I'm not skipping any. These are just happen to be the dates that I screenshotted. It's March 30th. That was another one I'm going to get to in a second. Where's the 20th? Here it is. Okay. Again, there was the primary sell signal, but if you missed it, this is what I do, highlight multiple opportunities. So this is where I think, that when you walk into a shopping mall or you go to Disney World and you have those the little kiosks, you walk up to the map of the park or the shopping mall, and they have a little drop pin that says "You are here." That's kind of where I think we are. And again, it's almost uncanny if you look at these charts, and I'll post them for you to compare. And this is that sell signal I just gave you the other day. I was highlighting, again, this was back in late 2021, just before the start of the year. After the bear market had started, nobody knew it. I suspected it. We had targets going down, and we went on down. We hit T4. But by the time we hit T4, and we did go through the 200s, I'll get to that in a second. I had laid out, and I had at the time deeper targets on the weekly charts than the daily charts. And the last chart I posted here was this one. I just jumped ahead looking at the bear market rallies. Remember, we had that, I started highlighting the divergence that we had back then in February. So this is when, looks like I gave you additional targets, because at that point, like I said, the charts are dynamic. You guys know that if you follow me for a while. Sometimes if I have multiple targets, I'll call in a trade early. We've done that with a couple trades recently where I say, you know what? I'm going to close it out here. We made a nice profit. My confidence in the additional targets isn't high, or it's not worth the risk reward, or I see divergences or something else, and pull the plug. Likewise, I'm just as likely to add targets to an existing trade if it starts working out and I see the developments I want to see. Among other things, the individual components of the NASDAQ 100, certain sectors like semis, maybe financials, maybe what treasury bonds are doing, credit spreads. And so I extended targets. And then here in February, late February, and we had a double bottom that was still divergent low. The divergence just extended right here. Divergence. I'm trying to use my line tool, guys. Bear with me. Divergence. Same divergence. So it was a low there, which I highlighted. Made an equal and still divergent low. Then we broke out. We gamed that counter trend bounce. There were other charts posted. Again, if I sat here and went over every chart from every 60-minute chart from late 2021 and early 2022. But this was it. That was the biggest bear market rally, the first one. There were two big ones. And that one ended on March 30th. I'll show you real quick. And so this was posted on March 30th. And I said, okay, it's time to get short again. Or about to. QQQ sell signal to come on a solid break below this uptrend line / 60-minute rising wedge. We were at about 370 right there. Again, March 30th. Let's go back to the two-day chart. And you can see it doesn't look like, you got to zoom way back in. This was it right here. There's that double bottom, which we gamed. I started highlighting the divergence when it started there. We never went any lower. We just extended the divergence, and we had the first of two, which we gamed them both. And again, with impunity. That was the sell signal right there. That was, as I just told you. I'm going to zoom in so you can see it. Put my crosshairs on it. See, on the pop-up box on the upper left-hand corner, March 30th. So we exited the longs, got in, gamed the next leg down, and we did the same thing back here. And it was also a rally back to the 200-day moving averages, which helped us exit. So again, that's how we successfully navigated and turned really a 38% drop into 50+% if you're just trading the indexes. So look, guys, again, as I said before, history doesn't always repeat, but it often rhymes. And whether or not it plays out the same exact way this time around, which would be obviously that sell signal we just got, if it matches that other one I highlighted, I'm going to go down. We'll hit T4. That should come in around my 200-day moving the 200-day moving averages. We'll turn back on the lines. But remember, if we get down here to the 200s, which is also the top, it's very good price support, about 636. You're most likely going to flip this trend indicator right here. Now, and if we go up here and then down there, then I'm still correct on the call. Just got in a bit early right here. But again, to me, it's been, this is a, T1 was hit there, T2 was hit there. I try to speak to both the trend trader and the swing trade, the active swing trader. The trend trader is going to say, "Yep, I like it. I'm gonna go here." It's based off the 60-minute chart, so I'm gonna push short. I'm going for a 15% drop to T4, so I'm going to give myself a 5% stop loss above my entry price. That's a nice 3-to-1 risk reward ratio, and I'm going to sit tight. And if you've sat tight, it's been the best trade. No, you went, at one point you got slightly underwater or equal back break even, but you're still profitable today. And there it is. There's the recent sell signal, and again mirrors what happened back then. But the most important thing, and guys, I say this repeatedly because it again, I always say this isn't a follow me site. I provide analysis, my thoughts on the market. I'll tell you what I'm doing. I have no problem doing that. What I'm doing personally, I'll sometimes give you a bullish or bearish trade idea and tell you I'm passing for whatever reason, or I'm taking this one. But at the end of the day, even though that's what I'm doing, you take it with your own analysis. pass on the trade ideas you don't like. Go with the ones you like. You might have your own price targets. Might be different from mine. But at the end of the day, I just hate when I read that somebody's getting beat up because they're only taking one trade. They're only taking the semis or the NASDAQ 100 or the gold mining stocks or Bitcoin or whatever goes against it. And I'm just picking, most of those, everything I just mentioned are all profitable right now. But sometimes what happens is people want to, I've done this a long time. Everyone wants to buy right here yesterday because they read about how the market's going so strong and whatever bullshit headline that the media will fill in the blanks as to why this big rally is happening, why earnings season's so great, and why there's no way this market's going to drop. That's what they do. And when the market drops, when we get down here, the headline, the news flow is going to change. You have my word on it. Why it's so bearish. What caused the big drop? They're going to tell you here what caused the big drop. We're trying to predict it and trade it. So again, I just wanted to go over those similarities. I'll post the charts, and I just wanted to point out that again, this is that level on the daily chart. It's so similar. Again, when you go back to one of those previous charts right here, you see we had, again, this is from this chart was taken in late 2021. You had the high, the failed breakout to new highs. You kept coming up to that level. Once the breakout failed, you back tested it, you back tested it. And then you had a trend line break too to give you an objective short entry instead of taking a pot shot. So that was then, and again, the rest is history. We went from there. It kept going 38% before it was all said and done over the next 11 months. And this is now, and it's almost an identical setup. So I highlighted this, this resistance level, horizontal resistance level on the daily chart right here. You can see there's the failed breakout to new highs. It tried it again, failed both times. I have enough reactions there to say that's horizontal price resistance, the uptrend line back test, and that's it. So like any trade, and again, this is what I wanted to impress, like any trade, it either works out or doesn't. What I was trying to get to a minute ago is you can go back at any period of time, but if you even go just year to date and go through the trade ideas, there have been dozens and dozens of trade ideas, probably more longs than shorts on the site. Even the shorts that we've had with the stock market, think about this. We'll do it real quick. We'll get a little time in the video. If you want to wrap up now, that's the analogy. I just wanted to show you the uncanny similarity between the technicals and how the market was acting back then to what it's doing right now. And then, of course, where it went from there when the vast majority of analysts and pundits on TV and everyone says the market's in great shape. We just had a killer earnings season. Collectively, the Mag 10 are still spending. If you're going to trade off the news and the headlines and that's all you go with, good luck to you. If you're Warren Buffett and you want to invest on fundamentals and you have a 5-10 year time horizon, great. I'll give you my long-term thoughts all the time on where I think the market might be in 5 or 10 years, but it's like forecasting the weather. Who flipping knows? The weatherman can tell you with a good degree of probability whether it's going to rain this afternoon or not. Tomorrow, his or her chances of being correct on their call goes down a little. A week out, it certainly goes down more. That's kind of what we're doing here. So you guys know where I think we're going short term and long term. And again, most importantly, where the stop should be, where to take your shots. Where, if you covered T2, I gave you first, couple objective entries, the 50-day here. But then anything much more than that, like I said, welcome to the marginal new high scenario, but anything much more than a marginal new high, because what I don't want to see are these divergences taken out right here. And to be taken out, that means you go up, PPO goes up, and it crosses above these previous highs. You no longer have negative divergence. And then we could have some kind of blow off top a la 1999, something like that. I don't see it. Things are a lot different than 99, a lot different, but the technicals are the technicals. All right. So All right, just to wrap the video up here again, the key to this game, and there was a great comment somebody made. I replied, and they replied to me about you were talking about the recent fund that blew up from that 25-year-old AI guru who was way over leveraged. And again, those are some of the keys to the game, guys. You know, don't even use leverage until you've cut your teeth swing trading, kind of have a style that seems to be working, you're profitable. Then you can incorporate leverage. And there's the reckless use of it where you plow everything into the SOXS, the 3 times short or long semiconductor ETF, and plus SQQQ or TQQQ. You're tech heavy. You're betting one sector. You're betting it all on gold or gold mining stocks right now, or you're betting it all long or short Bitcoin. That's gambling, right? You're going to be very happy or not. I preach the benefits of diversification, the trade ideas here. I may cover the stock market on a daily basis, but it's only one single position. And so if you go through where I was going to go here, you click on trade ideas, hover, go down to completed trades. You can do it by category, but if you look at all the categories, and again, they should load by, did I click on it? Yeah, there it is. They're sorted. You can check by year, you can sort by symbol, sort by date, but they're all loaded down below. And again, you can see as you go through here, long. Some of these are duplicates because first price target long. That's a long, mostly longs here. But there are some, there were shorts, there were socks. I just skipped over, I missed it in the previous page. That's a short. We've been short the semis, very profitable there. This will there's a short trade. There's an update on it. There's one stopped out. Again, it's been mostly longs, and that aligns with what the stock market's doing. So while I'm looking at the setup on the short trade, and we are short the index, we're actually profitable. So it's funny. You look at the stock market, the S&P 500, if you want to call that the stock market. Probably, that or the Wilshire 5000 are the closest things to the stock market. But that just hit all-time highs, yet we have plenty of short trades. This is one right here. We had our second price target on REMX. And at the time, I even gave you an update and told you I think we would continue down. There it is, to T3, which I told you I favored. So here's a good example. Again, one of many. And you can go back on your own, REMX, in a bull market that just hit new highs. That's a recently completed trade. We shorted there. We hit that T2 for whatever I just said, 20% profit. And because I didn't make the potential T3, in that video I covered that day, I told you I favored it going down there, but since I didn't get out to you in time in advance, I didn't make it the official third target. But then we went on to hit it for 24% gain. In fact, that sector is down now 36.7%. One of the strategies in trading, again, some of the trades will exit with perfection. I've showed you some recent examples where we short right off the highs and we cover right on the lows, or vice versa going long. But then there's a lot of trades I'm happy with shearing some of the meat, not all the meat off the bone. 20%, take the money and run. Or 24 if you held it down there. But one strategy, guys, if you let's say you agree with a trade idea I give you, but you just think my targets are conservative, there's more upside, trail your stops down. I'll do that quite often, especially if I think there's more room to run. So when you get down, coming up on T2, what you do is you see, okay, we took out the 200s here, we hit T2. So instead of booking full profits, you took out the 200, you just set a stop, give it a little bit of room in case it does reverse. But that also allows the potential to make another, in this case so far, another 21%. And so A trailing stop you can do as well. All brokers allow those trailing stops. They ratchet automatically. For example, if you do a 5% trailing stop, you'll stay in the position until it always ratchets in at the lowest point and keeps moving that stop loss down 5% above the lowest point. So a 5% trailing stop loss probably would have took you out here and would have allowed you to milk that extra bit off the bone. So again, a lot of ways to do, to trade. But the point I was trying to make in this as I went through is that, even in one of the strongest bull markets, well, undoubtedly in history, we've got plenty of trades, including short trades, that have been profitable. Strategy, we shorted this one and then turned it around long. I meant to do an update on it the other day, so this was a beautiful trade. We shorted this one right here, SNWGF. We covered it right there for a quick 23% profit. It's a video of those targets. And then I had it hitting T2 and bouncing from there back to this trend line. This was on June 24th. We'll do this one and we'll wrap it up. SNWGF. Nope, Snowline. What's your ticker? Snowline. I know it just hit that target because I had it and just took some out. That was it. So this is one we've been playing like a grand piano. Short entry there. First, second target hit, covered. It was also measured target of this head and shoulders pattern. Left shoulder, head, right shoulder 1, right shoulder 2, neckline. We shorted there. We covered there. Can't remember if we bounced it. T1, T2. I know I gave another short right here, second short entry, new trade on a trend line break. We took it down again for another 20 something, 25, 26% from here. Hit my second target zone. I told you I removed T3 and 4 because I started getting bullish. It was a lot of reasons. Support, and then gold hitting support, and me going long gold, silver, and GDX. And then I gave you 2 bounce targets in the last video update, and we just hit the second one, which was this trend line. So just this one mining stock alone, that was 37% upside. We probably made over 100% by 3 swing trades, batting 1,000, 3 for 3 on this. And again, this is swing trading, where a poor investor over the same time period, where we first shorted it, is still underwater if they're holding that stock. So, look, I might run this one the other way soon. I was looking for a counter trend bounce. I'm not looking at this point in time, nor do I think we're going to see new highs in the miners anytime soon. I'm very open to it. But just wanted to kind of highlight, the fact that even in, bull or bear market, it doesn't matter. Swing traders, we get in, we get out, we hit and run. It's kind of like the, special forces on a little operation. Go in, hit, run, get out quickly. All right, guys, we're going to wrap the video up here, and I will, like I said, I'll post those charts that show you the similarities, and we'll see. And I'll tell you this, if it doesn't play out, it's not going to surprise me or shock me, but I did want to just reiterate that we've had 2 objective short entries that push back to that level and the sell signal there. And if history does repeat or rhyme, then this should be the next stop. Remember, we've already hit T1, so that's check. We already hit T2, so that's a check. And the fact that we've been in such a trading range for a while, I'll be honest, I don't expect much of a reaction at T3. I think if we start getting down anywhere near T2, again, it's still support, but we'll probably go right on through there and hit my 4th target, hit the 200s, and then maybe get a bounce. Maybe not. We'll see. I'll let you know if and when we get there. And if we do this, I'll still be talking about that marginal new and still divergent high. And if anything between today and here or here changes, you know me, I'll let you know. This has been Randy Finney with Right Side of the Chart. Have a great day.